All right, welcome to The Explainer. Today, we're going to break down one of the biggest and honestly most stressful challenges for any Canadian entrepreneur, business financing.
Okay, picture this. You've just landed a massive contract, a real game changer, but you need new equipment to actually do the job. Or maybe sales are just through the roof, but payroll's next week and you're still waiting on those big invoices to get paid. What do you do?
So, are you looking at a lease, a loan, or maybe a line of credit? Let's dive in and figure this out together, because trust me, picking the right tool here can literally be the key that unlocks your company's true potential. But before you even think about picking a financial product, you've got to know exactly why you need the money. And that really starts with understanding the two main kinds of costs your business is going to face. First up, we've got startup costs. Think of these as the one-time, initial expenses you need to just get a project off the ground or, to launch a big expansion. And then there's working capital. This is totally different. This is the cash you need just to keep the lights on, to handle the day-to-day operations while you're managing the natural ups and downs of cash flow.
This really clears things up, right? On one side, you have your startup costs, things like your rent deposit, renovations, that initial pile of inventory. That's for getting started. On the other side, working capital is all about keeping going. We're talking employee wages, monthly rent, utilities, your ongoing marketing, all that stuff.
So it all boils down to this one single core question. Are you trying to fund a tangible thing, an asset, or are you funding your day-to-day operations? Seriously, the answer to that question is going to send you down one of two very different paths.
All right, let's head down path number one. This is for when you need a physical asset. We're talking a new vehicle for the fleet, specialized machinery for the factory, that kind of thing. And when you're getting an asset, your decision really comes down to this one fundamental trade-off. On one hand, you have leasing, which is all about flexibility. On the other, you've got buying, and that's all about ownership. And this chart breaks it down perfectly. Look at leasing. You've got low or even no down payment. It's often fully tax deductible, and it's super easy to upgrade to newer models. Now, buying is the opposite. It's a huge upfront investment, and it can tie up your cash and credit. But hey, you get immediate ownership, and that builds an asset on your balance sheet. And check out this real-world example from Ryan, a logistics entrepreneur. See what they did? They used leasing to get the business started, which preserved their cash. Then, once their revenue was strong enough, they were able to get a working capital loan to really pour fuel on their growth. Super smart.
Leasing is just incredibly powerful, especially for new businesses. We're talking companies that are maybe less than 6 months old or aren't pulling in $100,000 a year yet. Why? Well, you get huge tax advantages, you keep your cash free, and it doesn't mess with your credit rating. Plus, it's often way easier to get approved for than a traditional loan because the leasing company still owns the asset, which lowers their risk.
Okay, so that's path one. But what if you don't need a physical thing? What if you just need cash for stuff like inventory or making payroll? Well, that brings us to path number two.
Now, this is where a lot of people get mixed up, but honestly, the difference is pretty simple when you break it down. A loan is a fixed chunk of money for a specific planned expense. A line of credit, on the other hand, is like a flexible safety net for your ongoing cash flow needs.
So, a line of credit is for the short-term ups and downs, right? Like covering costs while you're waiting for a client to pay their invoice. A working capital loan is different. That's for a longer-term project, something bigger, like launching a huge new marketing campaign. You get a lump sum and pay it back over a fixed period.
So how do banks even figure out how much you can get? Well, here's a pretty common formula they use. It's not a random number, it's directly tied to the assets you already have. They'll look at your accounts receivable, that's the money your customers owe you, and your inventory, and they'll calculate your limit based on a percentage of those values.
Okay, so we've looked at the different tools you can use, but now we need to zoom out a bit, because your decision doesn't happen in a bubble. The wider economy, and especially interest rates, plays a huge role in all of this. As of right now, when we're recording this, the Bank of Canada's policy interest rate is sitting at 2.25%. Now, obviously this number can and will change, so it's always smart to check for the latest rate.
And it's not just us saying it might change. The Bank of Canada itself has said the outlook is vulnerable. What does that mean for you? It means the rate could go up or down, and that directly impacts how much it's going to cost you to borrow money.
So let's just boil it down to the simplest terms. When interest rates go up, loans get more expensive. When they go down, it gets cheaper to borrow money for growth. It's that simple. And that can really change the math on whether it makes sense to finance something or just use your own cash.
Okay, we have covered a ton of ground. So let's bring it all together and boil it down into a simple guide to help you make that final, critical decision.
All right, think of this as your decision-making cheat sheet. If you need equipment but you want flexibility, you should probably be looking at leasing. Want to own that asset for the long haul? Then you're buying it. Got a specific growth project? That sounds like a job for a working capital loan. And if you just need that day-to-day cash flow safety net, a line of credit is your best friend. So we've walked through the whole framework. You know the options, but now the final step. That's all on you. You have to ask yourself, what does my business truly need right now? And being honest with yourself when you answer that question, well, that's the key to making the absolute smartest financial move for your future.